In the last lesson, we learned the basics of calls and puts and why we might want to buy or sell them, and the risk versus reward for each strategy. But what many new option traders don't know is that, just like trading stock, you can buy and sell option contracts instantly on your computer with just a couple of mouse clicks. Here I have pulled up what is referred to as an option chain. This is a list of all the available options for a given stock listed by expiration date, with the most recent expiration on top, and then within that expiration by strike price, with the lowest strike price on top. We have two sides, calls on the left and puts on the right. This is a pretty standard format that you will find at most brokerage houses or websites, like Yahoo Finance. The platform I have up here right now is the Thinkorswim desktop software provided by TD Ameritrade. There are a lot of choices when it comes to a trading platform, but in our opinion, Thinkorswim is going to be your best bet. Thinkorswim is very powerful, free with any TD Ameritrade account, comes with some of the lowest fees in the industry, and has great support. For these reasons, it's also one of the most popular trading platforms out there. So no matter what you're trying to do, it's very easy to find answers. For these reasons, it's our first choice for an option trading platform. If you're using another broker or you're still trying to decide on a broker, we highly recommend signing up to TD Ameritrade. The advantages of the Thinkorswim platform are going to make trading a whole lot easier and more profitable. And if that wasn't enough, we have negotiated discounted commissions only for OptionStrategiesInsider.com members. So when you place a trade with TD Ameritrade, it will cost you less than everyone else. Coming back to Thinkorswim, we're looking at Netflix options. Netflix and most other publicly traded companies have options. In order to see if a stock has options, you just come up here and enter the stock symbol. If you have a company in mind and aren't sure what their stock symbol is, that's an easy fix. Just ask Google and they'll provide you that information. Let's go back and look at Netflix stock and look at the option chain with more detail. As previously discussed, the options are listed first by the date they expire. The option dates then go down in order, with the ones expiring in the longest amount of time on bottom. These ones down at the very bottom, that expire in a year or longer, are referred to as leaps due to their long duration. The option's expiration date is listed first thing on each bar. You have the day, month, and year of the option's expiration. And then after that, in parentheses, you have the number of days from today until that date. The rows that have text written in yellow are weekly options, while the ones listed in light gray are monthly options. Monthly options are what most people trade, and what we trade here at OptionStrategiesInsider.com. If we open up a month, we'll get a list of options available for trading, listed with call prices disseminated on the left, and puts are disseminated on the right. These are separated by strike price, which are listed going down the page from smallest to largest. On each line, there are prices for that option contract. Notice there's a bid price and an ask price, just like stock. The bid is the most someone is willing to pay for that option right now. The ask is what someone is willing to sell that option for right now. When the bid and the ask meet, then there is a trade. So if we want to sell an option immediately, we would sell on the bid price, and if we wanted to buy an option immediately, we have to buy on the ask price. Let's discuss what would happen if we wanted to buy one of these call option contracts. First, we should understand that one option contract controls 100 shares of stock. So if we buy one of these option contracts, we will be allowed to buy 100 shares of stock at a price of $165 up until the date of September 15, 2017. And if we bought 10 contracts, we would be able to buy 1,000 shares at a price of $165 up until that date. For now, let's just stick with the strategy of buying one Netflix September 165 call option contract. How much is this going to cost us? Well, we have a couple of options. We could put out a buy for a lower price than the ask and hope someone takes it. If the market is 460 at 470 and we put out a bid of 465, There's a good chance someone might want to do that, and we may get a fill. However, if we don't want to take any chances and want an immediate fill, we would need to pay the ask price of $4.70. This price of $4.70 represents the price of one controlled share, and because one option contract controls 100 shares, this would end up costing us $470. Even though option contracts control 100 shares, the prices are listed on a per-share basis. So whatever the price is listed at, you would calculate the cost of the trade by multiplying the price times the number of contracts purchased, so times 100. If we wanted to purchase 10 contracts, we would pay $4.70 times 10 contracts times 100 shares for a total of $4,700. We would then have the right to control 1,000 shares of stock. If our stock prediction was correct and Netflix shot up to $175 per share, this would be a nice winning trade. We would have the right to buy 1,000 shares of stock at a price of $165 and sell it for $175. Now, you might be thinking, buying 1,000 shares at a price of $165 is still going to cost $165,000, and that is a lot more money than you have access to. The good news is we don't actually have to buy the stock when we trade options. We can sell this option position back out for a huge profit in the exact same manner we bought it, and the cash just gets added right into our account without any stock ever coming into play. So if the 10 options we just purchased a month earlier for $4.70 per contract for a total of $4,700 is now worth $8 per contract for a total of $8,000, we can sell that back out, and now our bank has just increased by $3,300. Just like in this example, you don't have to wait until expiration to open or close a position. If you buy an option, you can sell that option back out at any time until it expires. Selling options works the same way. You can always buy it back until expiration. Now, let's talk a little bit about pricing. Options are referred to as in the money if they're currently in a position where they could be exercised. In the case of a 100 strike price call, when the stock goes over 100, the option would be in the money. If the call is trading under 100, it would be said to be out of the money. As you probably guessed, a 100 strike price put would be considered in the money if the stock trades below 100, and would be considered out of the money when it trades above 100. When it comes to option pricing, there are two main elements: intrinsic value and time value. The intrinsic value is easy to calculate for in-the-money options. It's the difference in the stock price and the strike price. So, if the stock XYZ is trading at 50, the 40 strike price call would have an intrinsic value of $10. This is the real value the option has right now. Out-of-the-money options would have no intrinsic value. If the 40 strike price call was selling for $12, it would be said that there is $2 worth of time value and $10 worth of intrinsic value. You can calculate time value by simply subtracting the intrinsic value from the total option premium. The more time you have to expiration, the more time value premium you're going to pay. This time value premium corresponds to the amount of time the option has to become more profitable. It would make sense that we would have to pay more for additional time to add further profits to the position. All right, that concludes this lesson on stock options. I know this was a lot of information to take in, but I hope things are starting to come together. Just remember, everyone is confused by stock options when they first start out. You have calls and puts and then buys and sells on each one. It's logical that it would be confusing. Just take it slow, and soon it will all start to make sense. Remember, we're just covering the basics right now. The good news is you're learning from the ground up, and by the end of this course, you'll have a trading strategy in place that will allow you to make consistent profits trading options. While other people come right out of the gate and lose, you will have the knowledge and the support to succeed. All right, everyone. I look forward to seeing you in the next lesson, where we're going to learn all the factors that go into option pricing and how we can leverage them to our advantage. This is going to give us the building blocks to create successful option trading strategies that continue to pay. Just make sure you understand everything up until this point. Take advantage of the quiz below, and I will see you soon.